Japan's 30-year bond yield just hit the highest level since those bonds even existed, and the US Fed stepped in to support the yen. Think about how insane that is for a second. The United States is actively helping defend another country's currency. If this becomes the new normal, the long-term implication is obvious: more dollar weakness ahead. This isn't a maybe it could happen situation anymore. This is the phase where it is happening. Welcome back, guys. It's OG here. Hope you're doing great wherever you are in the world. Before we get into this breakdown, make sure you check out my X account, OG John Age. I post market thoughts there that are often too early, too sensitive, or too real for other platforms. Copycats can copy content, but they can't copy the handle. Link is in the description. Also drop a comment saying OG and tell me where you're watching from and how you're doing. We always read the comments, and it helps separate the real ones from the noise. Now let's talk about what is quietly becoming one of the most important financial stories happening in the world right now. And most people aren't even paying attention. Japan. For decades, Japan has been treated like background music in global finance. Slow growth, aging population, massive government debt, and a market that never really explodes. So people stopped paying attention. They assume Japan is stuck in permanent stagnation. But right now, something has changed. And here's the thing: when Japan changes, it doesn't stay inside Japan. The consequences spread outward through currencies, bond markets, stock markets, and eventually into real household finances around the world. Japan's 30-year government bond yield has pushed into levels it hasn't seen since the late 1990s. That sounds technical, I know, but it's a major warning sign. At the same time, Japan's government debt has climbed to roughly $10 trillion, and the Japanese yen has fallen to levels versus the US dollar that we haven't seen in decades. These are not random data points. They're linked. And together, they're telling a story investors can't afford to ignore. Japan is the fourth largest economy on Earth. When stress appears in Japan, it doesn't politely stop at their border. It spreads into global markets, global liquidity, and global confidence. Even if you've never bought a Japanese stock in your life, what's happening in Japan can still hit your portfolio. A lot of people assume Japan's debt problem is old news. They've heard about it for years. Low growth, deflation, aging population. They've heard the same headlines forever, so when a new Japan headline appears, they ignore it. But this moment is different, because now the system Japan relied on for decades is starting to break, and the margin for error is shrinking fast. And one of the biggest reasons Japan matters is what Japan owns. Japan holds over $1 trillion in U.S. Treasury bonds, which makes it the largest foreign holder of American government debt. That means if Japan faces financial stress and needs to raise cash, it's not just their problem. It can directly impact U.S. interest rates, global liquidity, and risk assets everywhere. Let's start with the foundation of the entire issue: Japan's debt. Japan's government debt is about $10 trillion. Relative to the size of their economy, it's an extreme debt load. Japan's debt to GDP is around 260%, meaning Japan owes about 2.5 times what its entire economy produces in 1 year. No other major developed country is anywhere near that number. This isn't just some spreadsheet statistic. It has real consequences. Roughly a quarter of Japan's annual government budget goes towards servicing the debt. Not infrastructure, not education, not healthcare, just paying interest on money already borrowed. For years, this didn't look like a problem because interest rates were near zero. Japan basically had the ultimate cheat code. They could roll over endless debt with almost no cost. It was like having a massive credit card with 0% interest forever. But anybody who's ever relied on cheap credit knows one thing: that doesn't last forever. And in Japan's case, that era is ending. Because when bond yields rise, the cost of carrying that $10 trillion rises with it. And once yields start climbing, the math turns ugly very fast. Now add the second pressure point: the currency. The Japanese yen has weakened dramatically. It's hovering near multi-decade lows versus the US dollar, roughly in the mid-100s per dollar. This is not a temporary move. This is what happens when policy creates an imbalance and the market starts attacking that weakness. While the Federal Reserve raised rates aggressively to fight inflation, the Bank of Japan kept rates extremely low. That difference creates an interest rate gap, and capital always flows toward higher returns. If you're an investor choosing between holding US dollars earning real yield or holding yen earning close to nothing, the decision isn't complicated. Money leaves Japan. And when money leaves Japan, the yen weakens more. That weaker yen creates a feedback loop. Japan imports a major share of its energy and food. When the yen falls, those imports cost more. That means higher prices for households, higher costs for businesses. Inflation pressure rises. And this puts the Bank of Japan in a trap. If they raise rates to support the yen, they risk destroying the government's debt structure and choking the economy. If they keep rates low, the yen keeps falling and inflation gets worse. There is no painless option. For 30 years, Japan struggled with deflation. Prices didn't rise, they often fell. Economists begged for inflation. Now inflation is back, but not in a healthy way. Japan's inflation has been running around 3% on average in recent years. That might sound small compared to what the US or Europe experienced after the pandemic. But for Japan, this is a structural shock. Their entire economy was built on the assumption that prices would remain flat forever. Saving cash made sense. Holding money didn't destroy your purchasing power. But that world is gone now. Cash is losing value. Old habits are breaking. And policymakers are forced to respond even though every response carries risk. And that brings us to the bond market, because this is where Japan's system starts showing cracks. Higher inflation means the Bank of Japan can no longer justify unlimited money printing and zero rates forever. So the mechanism that held Japan together for decades is now being unwound. For years, the backbone of Japan's financial system was quantitative easing, and Japan didn't just try QE, they perfected it. Here's the simple version. Japan spent far more than it collected in taxes. To cover the gap, it issued government bonds. In a normal country, investors need to buy those bonds. If investors don't want them, yields rise, borrowing gets expensive, and governments are forced to tighten spending. Japan chose a different route. The Bank of Japan stepped in and bought massive amounts of government bonds using newly created money. Over time, the BOJ didn't just support the bond market, it became the bond market. Today, the Bank of Japan owns more than half of all Japanese government bonds. Let that sink in. The central bank is the dominant buyer, the dominant holder, and basically the price setter. That kept yields artificially low for years, allowing the government to borrow endlessly at almost no cost. But that system only works if inflation stays near zero. Once inflation shows up, the entire logic breaks. Since around 2022, inflation has forced the Bank of Japan to shift. They slowed their bond purchases and have started reducing support. That means the biggest buyer stepped back, and in some cases, even becomes a seller. Markets don't need complicated explanations for what happens next. When the largest buyer disappears, prices fall. When prices fall, yields rise. That's exactly what we are seeing right now, and the consequences are huge. Higher yields mean higher interest costs on the debt. Higher debt costs crowd out government spending. Higher yields also hit the balance sheets of Japanese banks, pension funds, and insurers, all of which are deeply exposed to government bonds. And there's another pressure point people in the West underestimate: tourism, especially tourism from mainland China. For years, Chinese tourists were a major source of spending in Japan. They came for shopping, luxury goods, electronics, culture, food, and Japan benefited massively. But that tourism flow has slowed sharply, not because of COVID restrictions, because of geopolitics. Tensions between Tokyo and Beijing have escalated around Taiwan and regional security, and Chinese authorities have discouraged travel to Japan. The effect is real. Visitor numbers dropped. Hotels offer discounts. Retail slows. Small businesses feel it fast. Even if it doesn't immediately show up in the GDP headlines, it shows up in livelihoods. Japan is stuck between superpowers, and the economic cost of that position is rising. And then comes the deeper issue, the one that makes Japan uniquely hard to fix: demographics. Japan's population is shrinking, and it's shrinking faster year by year. The population peaked around 2010 and has been declining since. Projections show Japan could lose over 25 million people by mid-century. That's not just a decline, that's a structural transformation. Japan's median age is close to 50. There are more people over 65 than under 15. The workforce shrinks every year. Fewer workers means less output. Less output means lower tax revenue. But at the same time, an aging population needs more health care and more pension support. So Japan gets squeezed from both ends. You can't grow your way out of debt when your workforce is collapsing. You can't fund pensions easily when the base of contributors shrinks. Eventually, the math becomes brutal. And these demographic problems are exactly why Japan's old model no longer holds. For decades, stability was rewarded. Saving cash made sense. Now, inflation erodes savings. The social contract is changing. So where does Japan go from here? There are a few possible paths, and none of them are painless. One option is managed decline. Japan stays wealthy, safe, advanced, but accepts slow growth and focuses on preserving quality of life instead of chasing expansion. Another option is immigration reform. Bring in workers, offset population decline. but that requires major cultural and political change. A third path is automation. Japan is a global leader in robotics, and technology could replace some labor shortages, but this takes time and might not be enough. And the darkest scenario is a debt reset. Rising yields trigger instability, currency weakness accelerates, and confidence breaks. Most economists call that unlikely, but not impossible. The most realistic outcome is somewhere in the middle. Slow growth, incremental reforms, careful debt management, no dramatic collapse, but also no return to glory. Japan stays strong, but under pressure. Now here's the question that matters most. Why should you care if you don't live in Japan, don't own Japanese assets, and never even think about the yen? Because Japan is too large and too connected for its problems to stay contained. Japan is the largest foreign holder of U.S. treasuries. If Japan needs cash to stabilize its domestic market, one option is selling foreign assets, including those U.S. treasury holdings. If Japan starts selling treasuries at scale, it pushes U.S. yields higher, and higher U.S. yields don't just affect bond traders, they affect mortgage rates, they affect corporate borrowing costs, they affect stock market valuations, they affect consumer spending. Even small yield shifts ripple through the entire financial system. The second global channel is currency and trade. A weaker yen makes Japanese exports more competitive, hurting competitors in the US and Europe. It shifts trade balances. It increases currency tensions. At the same time, a weaker yen makes Japan cheaper for foreign tourists and investors, creating both risks and opportunity. The third global lesson is demographic. Japan today is a preview of what many other countries are approaching. China, South Korea, much of Europe, aging populations, shrinking workforces, rising debt. Japan is a real-time case study of what slow-motion economic stress looks like before it hits everyone else. And the fourth angle is opportunity. Stress creates mispricing. Some of Japan's best companies trade at valuations that reflect deep pessimism. Big-name investors are already increasing exposure, betting Japan will navigate the storm without collapsing. That doesn't mean everyone should rush into Japanese markets. It means Japan is no longer just a stagnation story. Japan is now a live experiment in how modern economies deal with debt, demographics, inflation, and monetary limits. And the bigger takeaway is simple. No economy is invincible. Japan was once viewed as unstoppable in the 1980s. Then came decades of struggle. Now it faces a new set of constraints at a time when global debt levels are already elevated. Japan is unlikely to implode overnight, but it's also unlikely to return to rapid growth. The most probable outcome is slow adjustment and constant pressure on policymakers, and even a controlled outcome in Japan can reshape global markets. That's why paying attention now matters. Bond yields, currency moves, and policy shifts usually signal the change long before the headlines catch up. Japan's bond market is flashing a warning. The debt problem is real, and ignoring it could be costly. If you found value in this breakdown, let me know in the comments how this connects to what you're seeing in your own country. And make sure you're following me on X at OGJohnAG for updates that move faster than the mainstream narrative. Like always, invest with logic. OG is out and about.